something caught my eye. We all know it. 40% of the S&P 500 revenues are sourced outside the U.S. Let's put that over on the left side. On the right side, I wake up and I read about how the ECB has taken charge of an Italian lender, Banca Carige. Now, there's a lot of banks that are insolvent or have non-performing loans. So the first issue is I'm not sure why they picked this particular bank. But having said that, you know, our problems are basically that the rest of the globe is slowing and a lot of other issues crop up. But isn't that really the main issue that the markets are dealing with, in your opinion?
Certainly, and that was the story in 2018. The weakness really started overseas, and particularly China, that is slowing regardless of the tariff pressure that they're now feeling. They're going through their own deleveraging process. It's not really deleveraging, it's trying to control the excessive credit growth, but they're slowing nonetheless. Certainly Germany, which is dependent on exports relative to their economy since it's 40%, well, they're feeling the pressure of a slowdown in China and other parts of Asia. South Korea, very dependent on exports, they're feeling the pressure. So we saw a slowdown in global trade last year that is now beginning to affect the U.S.
And the other question you had in your writing I found interesting, would you rather have a 3.5% Fed funds target rate and a 3.5% economy, or would you rather have the current 2.25-ish range and have a 2.25-ish to 2.75 economy? I like that reasoning. Can you continue with that notion?
Well, if the Fed is done, let's just say, which the bond market is certainly pricing in, well, then we should be worried about growth, because if the Fed's done with this hiking cycle at a Fed funds rate of 2.25, 2.5, which is barely above the rate of inflation, then we have bigger issues that we have to deal with. It shows the huge amount of sensitivity that the economy has to very small changes in interest rates, which makes sense because we have created a very credit-dependent, cycle-dependent economy on credit rather than savings. But I think that's an issue. If the Fed is able to get the Fed funds rate to 3%, let's just say, it means that the economy's actually hung in this year. Now, you get to 3%, you're still going to get to eventual slowing, but I'd rather have a Fed funds rate at 3 because the economy is good, giving the Fed room to move downwards when the economy eventually slows, rather than getting stuck at 2.25, 2.5, because that reminds me too much of the Bank of Japan getting stuck near zero that they have never been able to get themselves out of.
Boy, and that's a good place to leave the conversation, because those who are criticizing Jay Powell ought to contemplate that very notion.